My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Friends, I'm just trying to make you a little money. Hey, my job. Entertain, but also explain, because this is a very complicated day. So call me at 1-800-743-CBC. Tweet me, Chip Cramer. The absurdity of earnings season has arrived. It didn't take long, did it? People are already doing stupid things. And you know what? I got to point them out to you so that you don't make the same mistakes. I am on a mission to make you a thoughtful investor, not a thoughtless trader. And I'm going to use this moment to teach you the difference. So on a day when the Dow lost 325 points, NASDAQ shed 0.76%, and the NASDAQ tumbled 1.01%, really ugly over there, we saw stocks trade all over the map as part of what I call the quarterly repricing process that is earnings season. Now, you need to know that the vast majority of the time, most stocks just trade with the stock basket that we call the S&P 500. If there's no big event that changes things, then nothing really happens other than the associated moves extrapolated from external forces that are often tangentially related to a company's future and, yes, the basket of the S&P. What's an associated move? Today, energy prices collapsed after it was reported that Israel is not planning to attack Iran's oil facilities, which are pumping oil out, producing about 4 million barrels a day, most of it going to China. Hey, speaking of China, we already knew the market was sputtering after that bout of stimulus, but today we got some real bad news. LVMH, the incredibly good luxury good titan, think Hennessy Cognac, Louis Vuitton clothes, Moet Champagne, Tiffany, Christian Dior, reported a 16% organic sales decline in Asia ex-Japan last quarter, and that was driven by weakness in China. That is just incredible. Clearly, the Chinese Communist Party stimulus hasn't kicked in yet. So with China demand weakening and no threat to Iran's fast oil apparatus, the price of oil just plummeted, closed down almost 4%, taking West Texas to $70 a barrel. It was a brutal round trip, too, as oil had roared in anticipation of Israel taking out Iran's oil facilities. With that concern possibly off the table, we got a stunning decline, not just in the crude, but in the oil stock complex. They, quite frankly, were obliterated. I found myself wondering if the oils are even investable at this point. It's no use trying to call the bottom of something that could go from 70 to 50, and 50 is where the Saudis say it could be headed, because OPEC has no production discipline anymore. Of course, anytime oil goes down, we typically get a knee-jerk repricing of all the retailers, restaurants, and travel and leisure stocks that should be winners in a world where consumers have more money in their pockets from lower gasoline prices. And that's exactly what happened. The cruise lines, for example, big users of oil, terrific travel plays, just exploded into the stratosphere, leading the entire market. Carnival jumps up more than 6%. Norwegian roars 4%. Royal Caribbean rallies almost 3%. Makes a ton of sense. But I think that instant revaluation could always wash away tomorrow. And I say that as anyone who likes the cruise stocks, and I do. By the way, I also like the restaurant stocks, but not so much that Texas Roadhouse should be up 3% or McDonald's up $3.50 to a new high. Too robust for me. But traders can't resist these often bogus revaluations. Hey, I hope they ring the register. When you extrapolate from one company's earnings to the rest of the industry and then to its customers, you rapidly get to the height of absurdity. ASML, a Dutch semiconductor capital equipment maker with a virtual monopoly on its part of the food chain, reported a heinous quarter today. This came out of nowhere. ASML wasn't even supposed to report today. It was a mistake. The panic from this one spread throughout the semiconductor world, bringing down everything related to microchips, including the ones that are dedicated to artificial intelligence, which is the one end market where ASML said things are smoking. But because ASML wasn't supposed to report, no one was ready. So the whole group was just a free fire zone. There was no effort to distinguish between AI-related chip makers and everybody else, which is why NVIDIA got clobbered, even though ASML talked about AI as the one bright spot. More on that later in the show. The real misinformation comes in the drug stocks. Now, I've done a lot of work on Johnson & Johnson covering today for my backgrounder, the company, before I go on air, for Squawk on the Street, try to really dig in to help you. I saw the numbers, and they look great. With the exception of the medtech portfolio, it turns out that things are even better than expected with the pharma portfolio, especially J&J's cancer drugs, which are truly revolutionary. They have an amazing treatment for bladder cancer, something used to be just fatal. The medtech weakness was all due to some problems in Asia, and the excuse made total sense. Moreover, this Spravato franchise, that's their psychiatric ketamine drug that makes people feel like life is worth living if they don't. It's growing like mad. I've been praising J&J's endgame work with the plaintiffs' lawyers who are suing as part of these endless talc lawsuits. The company's created a subsidiary to handle this and filed a bankruptcy accepted by a Texas court. Real bad venue for the plaintiffs. 83% of those who are suing want to settle. You get that overhang, probably be about $8 billion, and it'll be measured over multiple years, not just one big check. Well, let's just say you got a brand new J&J, and that could happen relatively soon. So this morning I'm on air, I'm looking at the stock of J&J and thinking, well, I don't know, 3, 2 up, but it's down. I mean, it's literally down $1. I mean, that was nuts. A price set by morons who haven't done their homework. I've gotten to the point in my life where I'm not going to accept the market's judgment when it's plain wrong. So I called out the stock prices being fixed by bozos, and yes, I even invoked the fabled Scrooge McDuck. All right, this was the moment to reevaluate J&J up, not down. Yet millions of dollars are being flushed down the drain at that moment. Now, fortunately, the useful idiots were defeated, and the stock finished up $2.50 or 1.5%. It's got room to run. Okay, how about my Goldman Sachs, my alma mater? I saw the earnings report, got my backgrounder, did all my work, had my models, found myself thinking, wow, this is some story. David Solomon, the CEO, is putting up fantastic returns. I figured it should go up maybe 2-3 points. No, it opens up $16. I mean, who the heck paid that? What kind of bozo the clown paid $16 higher? Who didn't even care what price they paid? What a chowderhead. I hope they aren't playing with your money. Of course, that overpay then triggers the opposite, an underpay. The stock proceeds to drop $25 in a totally chaotic moment. Then it bounced, only finished down a few cents. I wonder where this powerhouse would have traded if people buying and selling it knew how good it really was. That's shameful trading. Price discovery is a nasty game. I saw it happen last week when Wells Fargo reported a terrific quarter. Initially, I saw its stock plummet $1.50. I wanted to throw something at the TV, but I used to do that. I actually threw a brick at the TV. I'm out of that game, okay? I got my backgrounder, quickly realized that it was a much better than expected quarter, the best of the bank so far. If you stick around, I'll be speaking to Charlie Scharf. First on CNBC, never been on. 5 years, Wells Fargo, stock's up 9% since then. Now, I want to make one thing clear. I'm not saying that everybody's a moron. I'm saying there are details that informed people are looking for, benchmarks we've accepted going into earnings. Yet for the first few moments of trading, there's just obviously oblivious action based on who knows what. It's definitely not the key metrics. It's definitely not the homework. Bottom line, this is just the sloppy way that Wall Street reconsiders the price of a stock when compared to its peers and some parsed headlines during earnings season. Thank heavens it only happens 4 times a year. It's a hugely vital time, though. The only time a stock is unmoored from the S&P. Yet if you're not a professional, you should not be involved in this process. There are so many people playing with so much money, professionals who pay people fortunes to figure this stuff out. Let them fight to set the price. For regular investors like you, trying to trade that initial post-earnings action is just an easy way to lose money 4 times a year, like clockwork. Let's go to Hutch in New Jersey. Hutch.
Hey, Jim, it's Hutch from Stockton, New Jersey. I was wondering what you thought about
Hutch, are you kidding me?
PayPal.
Stockton?
Stockton.
What are you?
Yep.
Well, you in Sturgeonsville in? Where are you?
I've been Stockton in.
Oh, man, I love the Stockton Inn. There's a small hotel with a wishing well. Let's go to work. Actually, that song, Rodgers and Hart, is based on that hotel. How do we get? Let's do something.
PayPal. What are you thinking about PayPal?
Oh, my God. This guy, Alex Chris, he has just energized that place. Ever since I saw David Faber. David Faber should not be jealous of my interview with Charlie Scharf because I'm jealous of his interview with Alex Chris, if you want to play that game, because it was at the bottom. The stock's down $1 today, 79. It is by half now. The stock's on a parabolic move by half lower. Today's action is a classic example of Wall Street reconsidering the price of a stock during earnings season. For all the home gamers out there, I am urging you not to get involved in this process. On May tonight, Wells Fargo CEO Charlie Scharf is about to celebrate his 5th anniversary running the bank. And I'm sitting down with the executive from the company's New York City office. It is a rare and exclusive 2-part interview. You do not want to miss it for a very important stock. Then Swiss watchmaker Breitling is celebrating its 140th birthday. I got one of the first ones. Just kidding. So I'm checking in with the company's top brands to discuss the state of the luxury watch market, the NFL partnership, and what the future holds. Plus, as I just said, chip company ASML plummeted today on an earnings report, and I'm starting to realize that there are 2 very different semiconductor industries here. I'm going to share the details about the chip space that you need to know in order to continue to invest in these stocks. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
On Friday, Wells Fargo, the bank, reported what I consider a great quarter, and the stock roared, kicking off a terrific earnings season for the banks. Do you know in the last 3 days, this thing's rallied over 9%, which is very good news for me because we own it for the Travel Trust. We'll be going over it tomorrow when we do our club meeting. But as much as it seems like a reaction to the quarter, the truth is we're witnessing the latest payoff from CEO Charlie Scharf's long-term comeback plan. He and his team have been working hard to turn this once proud, then troubled institution around, moving into investment banking aggressively, investing in technology, cutting unnecessary costs, all under the watchful eye of the regulators, who are still keeping close tabs on Wells thanks to the misdeeds of the previous regime that Charlie had nothing to do with. I think it's clearly headed in the right direction, and the stock could have quite a bit more room to run. Scharf's a rare combination of visionary and operator. Boy, it's hard to beat that. We're now approaching the 5-year anniversary of Charlie Scharf's appointment as CEO of Wells Fargo. And for the first time since he took over in October of 2019, we got a chance to sit down with him earlier today for an interview. I want you to take a look. Charlie, you came into a very difficult situation for a storied bank, started in 1852. I have to ask you, given the fact that there were a couple of years of what's called controversy, why did you take this job?
Listen, I think it's one of the greatest jobs in the country. I mean, the Wells franchise is remarkable. And if someone handed you the pieces of this company and said, you got the opportunity to run this, and yeah, we've got some things we need to fix. If you think those things are solvable, then why, what else would you rather do?
Oh, but to some degree, you're a ward of the state after what happened, but you didn't do any of the things that you have to correct.
Well, listen, it was clear that we had to prioritize the work that the regulators required of us. That was on us. And to me, it was clear that we, with the right people, with the right sense of urgency, with the right process in place, we could get that done. And that's what the mission was. But that's part one of the mission. Part two is actually taking advantage of this great franchise. But we have to clear that gate, and we've accomplished a lot, but we still have more to do.
$2.2 billion, nobody else has that, what I regard as let's just say, ball and chain, and you had to do it, so you had to spend it. Anything you learned from putting all that money to work?
Listen, I think what I've learned is that if you set your mind to something, if you're really clear with people on what the priorities are, you get the right people, you manage to it, you can accomplish it. And I feel great about this isn't about me. This is about the 220,000 people at Wells Fargo who've accomplished all this.
And the headcount reduction every year. So what was it when you started?
272,000.
Okay, so in the last few years, last year, sold Wells Fargo Asset Management, sold Institutional Retirement Trust, sold the Corporate Trust, closed dozens of global offices, sold the student loan origination, stopped originating loans, sold the direct Canadian Direct, exited the auto business, stopped original personal lines of credit. I thought that was Wells Fargo.
No, listen, the core of Wells Fargo is what we do in consumer banking and lending, our wealth management business, our commercial bank, and our corporate investment bank. And so, part of the mission when I got here was to make sure that we were focused on doing the things that mattered most for the core customers of the company. And there were a bunch of things that we did. They were perfectly fine businesses. It just didn't matter to the core customer base that we had. And so they're better owned by other people.
Yeah, but why did you close wealth management and then open a different wealth management?
No, we didn't close well. What we did was we said, we don't need to manufacture our own product. We don't need our own asset manager. But we love the wealth management business. We have 12,000 advisors. That makes sense to keep inside the company. So let other people actually run the asset management business. We have the wealth advisory business here, and then we get to pick and choose what we think the best products out there are for our customers.
All right, so you have a storied background. You worked at Visa, tremendous technology background, JP Morgan. You have investment banking. You have retail. You are reinventing the bank in some very competitive areas, including investment banking, where you have to move all the way up the table. And how are you going to do this as fast as you'd like? Because you are not eighth in what you've done in your life. You're not a seventh guy. You're a one guy.
Listen, first of all, when you look at our franchises, we have a great consumer bank, which is, top 1, 2, or 3 in almost everything we do. Same thing is true in our commercial bank, and even in the corporate investment banking space. We have a great corporate investment bank where we've been banking the big companies in the United States forever and ever. The opportunities that we have are to build the businesses where we haven't been as strong, but it's taking advantage of all those relationships that we have. So whether it's, in the card business where we haven't had, the same amount of focus that we've had in other areas, go build that. We do business with, more than 60 million Americans and have the opportunity to spread our brand there. And on the corporate banking side, we lend to huge numbers of customers, both on the commercial banking side as well as on the larger corporate side. And we've got great relationships, but with the opportunity to get more entrenched in advisory and in the equity underwriting space. So it's leveraging all those benefits that we already have.
Okay, I'm retired from JP Morgan. I'm 56. I work with you. What's the pitch? What do you tell me about coming to work here?
Let me back up. How about if I tell you what our clients tell us?
Okay.
Because one of the really neat things for me was when I got to Wells, I had the opportunity to have lots of conversations with people. And I would set up these calls with all these CEOs of very large companies. And what I would hear from them is, we love doing business with Wells Fargo. You've been lending to us for a long time. You've been through good times and bad. You've got very often great treasury management relationships. And we want other options to deal with. And we think you guys are going to be a winner. And you're also going to look at our relationship and say, you're probably not making the returns you need to make. So this is them telling me, what I want you to know is we want to do more with you. And that's kind of a unique situation to be in, where you got the customer telling you that they want to do more with you. Now, we've got to build capabilities. We've got to have the best people in front of them. And so when you think about, what we're doing and why we're doing it, when you've got the customer saying this is what they want from us, and if you've got the credible people and credible products and services, we want to use you. That's a pretty neat position to be in.
At the same time, the Goldman Sachs reports this morning, a terrific quarter, blah, 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 by Dave Solomon. They're ultra uber wealth management. They've got the top 1. When I go to Wells Fargo, when I was just moved to my community, I knew I could hit them up. I could hit them up for $200 for junior baseball. Hit them up for $200 for the Santa, because that was the bank. It was the local bank. Do you still do the local bank and become this?
Absolutely. Listen, we are in a lot of ways the closest bank in the country to the communities we serve. We have more community branches than any other banks out there. That is the heart and soul of who we are and the way we've done business. And we're not abandoning that. But again, if you think about who Wells Fargo is, you go back to those communities. We serve consumers, we serve small businesses, we serve middle market companies. And years ago, before the banks got so big, if there was a large corporate headquartered there, we did business with them as well. And so now that we do this across the whole country, it's just a continuation of that and making sure that we're continuing to build the services that we can provide for them.
Okay, so you're reinventing the bank at a time when people are unsure how many people need to work. We've got tremendous technology in a ChatGPT form. When you do reinvent a bank, do you need all the people that you needed when you were at JP Morgan?
Well, I would say it differently. I think the technology that exists is incredibly exciting for the people that work here. And so you pointed out earlier, we have a lot less people than we had when I got here. And we try and get from point A to point B as much as we can by attrition. And what we try and use technology for is to help our customers and help people here do a better job. And we're just at the beginning of Gen AI, but we've been using AI for a long time in this company. And it's embedded in how we handle and how we analyze credit and how we do marketing and how we provide information to our bankers. And there's just another step to go. And so to us, it's the most exciting things for the people who work here, because they're going to have tools that they never had before.
All right, now you've been buying back a huge amount of stock. Mm-hmm. Actually, you're back to the number of shares you had before the crisis in 2007. You worked it all the way back. Why buy back stock if you can build out or buy a big investment bank yourself, buy a boutique, really suddenly become, look, this is our guys. You have this Centerbridge. I mean, that's great. It's a partnership. But why not plant a flag and jump to number 3, number 4, number 5 right now?
Well, first of all, what we invest as much as we can inside the company. That is the first priority. And as we, in a lot of the things that we've done to build the businesses where we've made progress, that investment is happening. But we do have an asset cap, and then we live under other constraints, just like the other big banks do. And so when you're limited in what you can deploy and in terms of what the market is asking for, you got to return it to shareholders. The idea of going and buying something sizable is just, it's not even on our radar screen. It's not what we're thinking. When we come in every day, what excites us is the organic opportunities that we have. And it's in all and as you pointed out before, we've exited the things that we don't think we've got great opportunities for. Everything that we do today, with some minor exceptions, we think we've got opportunities to grow organically.
All right, we're going to take a break in a second, but I got to ask you, have you taken any business from JP Morgan or from Morgan Stanley or from Citi or from Wells or from Bank of America because of your tremendous background and the people you've hired?
We've been lucky enough to attract people from a whole bunch of great companies.
About business. It's great to have a lot of people.
Business is, we compete with great people. And one of the things that I would say is when you look at the market shares that the big banks have, there's plenty of room for all of us to do well.
All right. Now we're going to have more with Wells Fargo's Charlie Scharf when we come back in a moment.
Coming up, in a transformational moment for the big banks, could 149-year-old Wells Fargo continue to innovate? Cramer's exclusive interview with CEO Charlie Scharf continues next.
Back on Friday morning, Wells Fargo reported a solid quarter with encouraging guidance, noting their net interest income, a very important statistic, should bottom this year before mounting a major comeback in 2025. And in response, the stock caught fire. That means profitability all the way down the line. I think this is a truly transformational moment for the big banks. Don't take it from me. Earlier today, we got a chance to speak with Charlie Scharf, the president and CEO of Wells Fargo. I already showed you the first part of the interview, but because this one is so important, we went overtime. So take a look at part two. There's so much that you've done in life, but Visa, you just killed it. I remember meeting you at Visa. You were a little abrupt with me. That's okay. I've since gotten over that. But what I do want to know is why aren't you made a credit card. You planned it. That's core. Can you grow? Can you go buy the GM credit card? How about the Apple credit card? Are there credit cards that you just want to own right now that other people aren't doing anything with that you're much better at?
Listen, our credit card business is doing extraordinarily well. We've launched 9 new products, I think, since I've been here. When you look at our point of sales on cards, it's up well over 50%. We're doing a great job growing organically, and that's where we think the opportunity is. It's not about buying portfolios or looking at other things at this point. I mean, again, when you look at what your opportunity is, if you don't think you've got the organic opportunities, you do need to look elsewhere. That's not how we feel about where we are today. We just feel great about the opportunities that we have, and you see it showing up in our results.
Right, now you have special relationships. I have to believe that because you're on the board of Microsoft, that you want everyone to at least sample Copilot. Are they doing it?
We are introducing Copilot in a risk-based way across the company, and I do think that there's great opportunities for people to use Copilot.
Does it make it so that there's more man hours and you have more productive people, or do you just need fewer people with Copilot?
Listen, I think, again, day one, it is people become far more productive and able to do a whole lot more. It's like email. I mean, the idea of waiting 2 or 3 days to get a note versus getting something instantaneously, you get a lot more accomplished a lot more quickly. And I think the same thing is true with a lot of the benefits that exist in Copilot. Business
Council, how do you feel about, just in general, the state of things in the country, where I know you went over and over again in all your conference calls, you stress hiring, employment is good, inflation is running down. It just seems like a halcyon time. But we always know it's a bank, but we always know, but we do feel, when I read you, you're very optimistic.
Listen, what I know is what we see. We have the facts in front of us, and the facts are the consumer's been extremely resilient. Consumer spend still continues to go up at a very measured pace, both in debit card and credit cards. When you look at deposit balances are still strong. Credit quality is still performing extremely well. Corporations went into this environment with very, very strong balance sheets. And so the facts are that things look pretty good, and the Fed has done a great job of managing this down under circumstances that people said were extremely difficult. So that's what we see. And so, yeah, we're pretty optimistic. We're conscious of the risks that exist in the world. We don't sit here and say risks don't exist. But what we see looks pretty pretty strong.
Okay, I imagine when you came in, there were things that you probably didn't even know, consent decrees that you didn't even know about, and you have been in a true Teddy Roosevelt arena situation. Did you ever think, when you were at Visa, JP Morgan, that you would be hectored, that people would say, this man is doing the wrong thing, and these were people who, there were only 100 of them, and a bunch of them are trained on you?
Listen, I understand why people were critical of Wells Fargo. And again, my mission in coming here was to change that dialogue. And the easiest way to change the dialogue is not for me to give a speech, but it's to actually show the results. And so that's what I think we're doing. And again, I feel great about the progress that we've made and have great confidence that we've got the ability to put these things behind us.
So you think you're able to preserve the greatness of this institution, historic institution, and at the same time lay off the people you have to do and make things compliance friendly and also simple. These are all things that you like. You like that challenge.
Absolutely.
Well, I don't know. I mean, what time do you wake up? When do you go to bed? What time do you? I mean, this is not the usual challenge for a banker.
Listen, my job isn't the hardest in the world, right? When you look at what other people do at this company, they've got hard jobs. Because again, I know you talk a lot about me, and I appreciate that.
Yeah, I do.
But we have 220,000 people. I have a great management team. We have 17 people on the operating committee. 13 are new to the company since I joined. The other 4 are new jobs. It is a great team. We work extraordinarily well together. Everyone is dedicated, and I'd pit this management team against any other financial institution in the world.
And your board, you have a lot of people who worked at other banks. It seems like an operational board. It's not a board that looks like a university that I know.
No, our board is deeply involved in what goes on at the company, and they provide the oversight that they should provide. They challenge us, as you point out. We've got board members that have been at other large financial institutions. They've experienced many of these things. And we gain great insights by the experiences they have and the way that they push us. But they're supportive when they should be supportive, and they challenge us when they should challenge us. And that's, I think, if you're a shareholder, exactly what you want in a board.
What do you tell them about what you think the Fed's going to do about interest rates? Do you care about the quarter half? Is that just the horse race that we talk about, and you laugh and say, why can't those guys think of something better to do?
It's a little bit of both. I mean, do we care about the quarter? Absolutely, because we care about our shareholders.
Right.
And that's why,
And so you have to have a view on interest rates.
Absolutely. But at the same time, I just also want to point out that the market can obsess on a quarter more so than we would. I mean, take last quarter versus this quarter. Okay. Last quarter, stock reacted badly. This quarter, stock reacted well.
Were you shocked? No, we talked. You knew it was going to be good.
It's the same company. The trends are not dramatically different. The things that we've been doing to build the business, the progress that we've been making haven't changed all that much.
But weren't you surprised that you said you were going to do something, you then did it, and your stock's up the most of any bank? I mean, what were people expecting? Well, you said exactly what you were going to do.
I do think, credibility is important, and if you say something, you should deliver. And we do believe strongly in that. Unless something has changed, in which case we got to tell people something is different, and here's why. But when people listen to us, your word is credibility out there, and it's just like the reputation of a company. It takes a long time to build, and it takes a very short time to lose, and we understand that.
All right, now. Speaking of that, I always felt that one of the beacons for San Francisco could be Wells Fargo. But we're at Hudson Yards. I don't see like an Embarcadero here. I mean, what about San Francisco?
San Francisco is still incredibly important, as is California. Listen, we're a national company.
Right.
We have over 10,000 people in Minneapolis. We have over 10,000 people in Des Moines. We have over 10,000 people in the state of California. We have over 20,000 people in North Carolina. I think we've got 4,000, 4,500 people here in New York. And that's not my doing. That's just what this company is. And so, we go where the talent is. We travel around all the time, and it works for us.
Do you have to worry about who gets selected in the fall?
Listen, you always think about that. But, we're going to work with both sides. And
you have a contingency plan, one or the other?
I'm encouraged by
Blue team, red team?
I'm encouraged by what both candidates are saying about the way they want to interact with business.
That's certainly more positive. I would not think. I think the current regime has been very tough on business. So perhaps, have you talked to Tony West at all? Talked to any of the Vice President Harris's people who really understand business?
I would say that both myself and people in this industry do engage with people on both sides of the aisle, whether they're current or future. And as I said, I think that there is a desire to make sure that the private sector is helpful as the country moves forward.
Okay, 5 years ago, came in, right about now. What's this bank look like 5 years from now?
Well, listen, we want to be America's greatest bank.
You would be America's greatest.
That's who we
Wells
want to
Fargo.
be.
You mean like it was before the destruction of the America's greatest bank?
That's who we want to be. Listen,
but when it was the Buffett Bank, when John Stump came on my show and he talked about the buck stopped there, but it hadn't, you could see that a once great bank was no longer great. You can get that bank to where it was before that.
Listen, our customers love doing business with us. Our customers want to do more with us. They're giving us that opportunity. And as I said, I think this is one of the great jobs at one of the great financial institutions. And I'm incredibly excited to be able to get from where we were to where we are today, but even more excited about what the future holds.
I like that message. Let's stop there. Charlie Scharf, Wells Fargo President and CEO. Thank you, Charlie.
Coming up, it's about time to talk the global luxury market. Watch the clock. Cramer's exclusive with Swiss watchmaker Breitling. Next.
Before we get into the thick of earnings season, I want to take a step back and spotlight a business that you don't see on our airways very much. That's Breitling, the privately held Swiss watchmaker celebrating its 140th birthday this year. Can you believe it? 140 years? They can give us a read on the highest of the high end. By the way, James Bond wore a Breitling in Thunderball. Okay, not Bond's best, but it doesn't matter. Sean Connery, whatever he did was terrific. He had the best watch. So let's take a closer look with George Kern. He's the CEO of Breitling to learn more about this iconic company and where it's headed. Mr. Kern, great joy to have you on Mad Money.
Thank you very much for the invitation, Jim.
Some things are timeless, and I tell people, because I wear my Breitling over the weekend, that you might love your Apple Watch, and I do. But when you're going out, you want to be in style. Is that the reason why your company is thriving now, even though we know that these things are so, like they're pretty much everywhere?
Yeah. No, one doesn't exclude the other. As you rightly said, it's for different occasion. You might wear your Apple Watch for sports or any outdoor activity. And yes, when you go out with your friends, your family, your wife, you take a beautiful, hopefully, Breitling watch on your wrist. And the beauty with this is it's a storytelling. There's an emotional link to a watch. I'm sure you remember your first watch.
Oh, yeah.
And I don't think that anybody would throw away an analog watch, whilst I don't know any collectors of digital watches. I know many collectors of analog watches because there's an emotion.
You are so right. I have, when my dad passed away, I have his Bulova that he had since he was 15. You're right. There's an emotional connection.
Absolutely.
That is so true. Does that mean that when I see you're opening boutiques, that people are buying a watch that maybe their parents had, or does it also mean that perhaps they feel like they've done well and they want to reward themselves with something that's not ostentatious, but makes you feel like you've done well?
Yeah. I mean, first of all, it's perfectly right. Especially after COVID, we saw how many people were buying luxury goods, watches in particular. We call it revenge buying. Or indeed, when you make a good deal, it's a reward for yourself. You try to do something good. And in a boutique, and we have 43 now in the US, you have the 360 of the brand. You have all the products available, you have the storytelling, and fantastic people selling them.
Now, one of the things that you've done that's a little, I would say, unconventional, you've got to deal with the NFL. And, I don't associate the two, but I want to know more.
Well, right from the beginning, we said at Breitling, we want to be different. We want to be more approachable. We want to be more relaxed and cooler than the other brands, which are very conservative. Swiss watch industry is very conservative and traditional.
Sure.
So we went into surfing with Kelly Slater, for instance. We went into triathlon. And now we have this amazing deal with the NFL, whereby we are launching 100 pieces per team, 32 teams around the US. And people love it.
That's fantastic. Fantastic. And they're going global, too. So they've had in Sao Paulo this year.
Yeah, absolutely.
Germany. Now, can you tell me what the state of the luxury goods market is here, say, versus China, where you have a small position?
So the U.S. is surprisingly extremely resilient.
Yes, I know.
It's an extremely resilient economy. Everybody was talking about recession. I mean, since 2 years,
right.
And it never happened.
No.
And actually, we're growing double digits again in the US since a couple of months, which is quite
double
unbelievable.
digits for your company. And these are not inexpensive items.
Yeah, absolutely. So we're very happy. China has been in a very difficult position. You have lots of youth unemployment. You have a real estate bubble in a way. Still, it is the biggest luxury market in the world. But we don't want to be dependent on one market, so we want to be a plane with 5 engines.
Very smart. I mean, LVMH was down 16 today in China. Some really terrible numbers when you think about it. For a great company run by a brilliant man. Now, I want to get a sense on when you talk about America double-digit, that says to me that maybe our country has a lot more people doing well than a lot of people think. Do you think the wealth is from stock markets? Is it from generational wealth? Is it from their jobs? Where's the wealth coming from to buy a Breitling, do you think?
I believe the USA is the biggest entrepreneurial country in the world. I don't know any other country in the world where the setting is put in a way that you can do business, that you can build business, that you can be and become an entrepreneur and do something.
You're talking about economic mobility.
Absolutely, absolutely. What is the objective of a government is to put the right frame in place, right? That's it. They shouldn't do anything else. And you have a setting which is great, much better here than, unfortunately, in many European countries, for instance, where you have too much bureaucracy and other taxes and etc.
Well, one last question. Do you find that men buy it for themselves, or are they presents?
No, men buy for themselves. Would somebody buy a car for you? You would never accept that. You would choose your car. It's the same thing for a watch. Whilst men buy a gift for their wives or girlfriends, which is very different, and they accept that. Right. They accept that.
Well, I've learned so much from you just in this time. I've always felt that our country has understated wealth, which I like. Of course, there's ostentatious people, but a watch is something that I don't regard as ever ostentatious. I always feel good with my brother. I never feel self-conscious, just positive. That's the best way to put it.
Absolutely, absolutely right.
Well, I'm so thrilled you came because it helps me understand the psyche of a big part of our country. That's George Kern, CEO of Breitling. Thank you so much for joining us, George. Really good.
Thanks.
We have money's back after the break.
Thank you.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
Before we start, I would like to dedicate today's lightning round to a man behind the camera. Today is his 60th birthday and a very special member of the Mad Money family. Happy birthday, Joe! He's been part of the action of the show for many, many years, and we just love him. Thank you for all you do, Joe. We can't do this show without you, and this special lightning round is dedicated to you. And now it is time. It is time for the lightning round. Great news. Round for gold. Let me say this like that by myself. So just going to know the soul question. Let me play the sound. And Joe's lightning round is over. Are you ready, Ski Daddy? Let's go to Mary Claire in Idaho. Mary.
Mr. Kramer, hey from Idaho, but I'm a Jersey girl through and through.
You got both bases covered. All right.
I do. So listen, we spoke a few months ago about cassava sciences. I since increased my position, set up an account for my college son, and we're doing great.
Well, I remember they do have an Alzheimer's trial, but Lilly has an Alzheimer's formulation that is very good. And Lilly does have the edge on everybody else. Let's leave it like that. I need to go to Dennis, New Jersey. Dennis!
Booyah, Jimmy Chill. How you doing?
I'm doing well, Dennis. How about you?
Can't complain. No one listens anyway, but I got
Never explain, never complain. How do I help?
That's even better. So I got something a little speculative. It's a company that develops driver assist technology in autonomous vehicles. It's called Mobileye.
I know Mobileye well. It's an Israeli company. Obviously, its big stake is held by Intel. We don't know what to do here with this. Intel, Qualcomm, I think it's just too hard to tell. I'm going to stay away from it. Let's go to... no. Joe's lightning round is over.
The lightning round is sponsored by Charles Schwab. Coming up, chipping away at the semiconductor stocks. Cramer is breaking down the latest action in the space. Next.
Right now, it's like there are two different semiconductor industries. There's the semiconductor industry dedicated to artificial intelligence, which is on fire. And then there's everything else. Today, we found out just how perilous everything else is when ASML, a gigantic semiconductor capital equipment maker, talked about the slow recovery outside of AI. Its stock fell $162, or 18%. With the semis, it's real best of times, worst of times. First, there's been weakness in some semi areas, namely autos outside of self-driving, along with the Internet of Things, some telco, and the personal computer. Second, everyone who owns these chip makers in any size, meaning institutional investors, has already either taken action and fled sell from the biggest weaknesses, or in some cases, they see green shoots for next year. It can take some pain. Its green shoots are mostly in PCs, both of which are about to get a boost from AI. Third, while the big boys do indeed have a clue, we clearly have a lot of investors, or maybe traders, or maybe jokers, who don't know a Frito-Lay chip from a semiconductor chip. How else do you explain what happened to the stock of NVIDIA today, which makes the kind of AI chips where ASML says there's no weakness? The stock plunged 4.5%, one of the worst performers of the day, as part of a broader semiconductor sell-off, even though ASML was explicit that companies like NVIDIA are doing fine. It didn't matter. Now, tomorrow, Jeff Marks and I are convening our monthly CNBC Investing Club meeting, and I was trying to figure out a scenario where some of our favorite stocks would come down, so we might be able to recommend them at better prices at noon. I didn't think that the price break would come from a semiconductor equipment maker like ASML, which saw a hideous 53% decline in orders quarter over quarter. Truly shocking. Even if AI chips are doing well, they can't offset the weakness in the rest of the industry. But this gives me a chance to explain that the semiconductor stocks are really only as good as their end markets. Last night, for example, Micron Sanjay Mehrotra came on the show telling us that everything in the data center was on fire and that he sold out of the high bandwidth memory chips needed for AI. He also predicted a big PC refresh cycle aided by the introduction of AI-enabled personal computers, which I think will be used for the holiday season right into 2025. So, I think it's going to be so huge that I keep endorsing the stock of Best Buy, even up here. They've got a giant allocation of these machines. Some 40% of all AI-oriented PCs from Microsoft will go through Best Buy. AMD has exposure both to the PC and AI, which is why we used the weakness to buy some shares for the Travel Trust today. It was painful to do so.
The House of Pain.
But we want to build a position into weakness, not strength. We want to get a better basis. That's how you do it as a professional. Now, we know from some recent surveys that many different telco companies are doing better, but they aren't by any means smoking hot. The Internet of Things and autos, they're just okay. Maybe they get better with lower interest rates, but I think there are better things to invest in. I certainly didn't want to take advantage of the sell-off caused by ASML to pounce on the other semiconductor capital equipment makers like Lam Research, very good company, Applied Materials, another company like KLA. They're all good, but they trade together. And if ASML is having such serious problems, you probably don't want to get involved in the part of the food chain that involves these companies, because they're going to go lower. But to go back to NVIDIA for a second, this is a company with a plethora of opportunities, and it dominates all of them. NVIDIA doesn't mess around with the semiconductor capital equipment makers. Its chips are made by Taiwan Semiconductor. We haven't really thought much about the equipment going into it. The Taiwan Semi reports later this week. Perhaps they can straighten us out on what's working and what isn't. Still, today serves as a really serious reminder that even the most bulletproof of semis can be brought down by others in its cohort, especially if it's in an ETF. If you can't tell a microchip from a potato chip, you probably would have sold the stock of NVIDIA today the way so many did at 210, 205, 200. But if you've done your homework, you know that not all chips are created equal, and you're now getting an incredible buying opportunity once again in the AI-related semiconductor stocks. I'd like to say, as always, bull market somewhere I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.